Well, let's get some technical analysis now. We're joined by Richard Morrish, Head of Research. Richard, thank you very much for coming in. Let's start with some analysis of the pound, shall we?
Yes, indeed, Anna. It's a pleasure to be here. Sterling is a market that basically has a major problem. It's in a major bear market. When we break through a cross state on the 20 and a harmonic point, and we took the 170.80 level, it led us to have this breakdown to 166, and we're having a technical correction within that at the moment, and that should target the market to possibly go as high as 175.64, but that's about as far as we would expect it to get. The market is in serious problems, and we're expecting a lot further downside pressures to come into sterling from here, and the whole point of this is that we are in a major problem against when sterling against the yen. The euro, by the way, isn't even out of the woods yet either. It's got the potential to go down to around 119, and sterling has got the chance to go down to 135, and this is why we brought along a slightly longer term chart which shows you what the impact of a fractured credit market was back in 81 to 84, and as you can see, we indicated on the chart with a little red arrow where we think we are roughly in the process at the moment, and effectively for sterling we're saying that the market is only just getting underway for the bear market. We're standing very close to an opportunity to see a very accelerated bear market from here, and whereas Gordon Brown has been held as a bit of a hero at the moment, he may well end up finding the fact that sterling starts collapsing on him, and that he goes from hero to zero very quickly and takes over the mantle of being the worst chancellor come into being Prime Minister since James Callaghan in '79. Certainly we expect a lot further pressure coming in sterling going ahead into the future.
That would be a dubious title, Richard, wouldn't it? What about the US markets then? What do you see over on the Nasdaq?
Over in the Nasdaq we're at very critical levels now. The market is poised at this 1,717 level. What we've seen in the market is if it breaches the 1522 level, then the market should get a very accelerated downside. But the thing is that everybody is going on VIX, it's oversold, and the market is going to get a bounce back. Looking at the intraday movements that we've been seeing in the market, it looks very much like everybody's got to the long side of this, and if the market as it's currently doing at the moment is probably a very tight inside day today, it could signal a very major turn next week. The critical point is that next week is absolutely vital for this market, because if it breaks next week onto the downside, the acceleration on the bear tack could be very quick and take us down to around the 1,108 level, which marked the 2002 lows. On the top side, for those that are looking for a rally, we expect it to get capped at around 1,952, but if it can get a constructive rally, it will go to 2,208. One thing we will stress in this is that as far as we are concerned, that this is just purely correctional within a long-term bear market. When we look at the fractured credit market, we are 2001, 2002, we're nowhere near as bad as where we are standing today in the credit markets, and as a result equities are not pricing in anywhere near the amount of damage that can be done.
Gold, of course, Richard, has been something of a safe haven play. Where do you see it heading?
Yeah, again, this is a very interesting market, because what we're in at the moment, we're in a consolidation phase. It's replicating rather similar patterning to the 2005, where we had the extreme extension high and then we did the big correction back. We expect the market has got opportunity to see down to the 690 level, but at the moment we would sit there and we're waiting for a date on the 22nd of November where if the market closed beneath 734, we would expect it to go back down again. But for us, the market looks very much like it's caught in a consolidation period until February the 22nd next year. And at that point, the market will have to make a decision. 879 or 811 is the dependent levels for the bulls or the bears. A break above, and then we should expect an surge in the gold prices back up to 1350, 1400. If we say the downside level break, then the bears will win the day, and we'll be sitting in a very bear scenario. One of the important things to remember is that as you enter the second phase of a credit crisis, commodities, and particularly the hard commodities like gold, do tend to perform, but this could be the last chance for the gold bulls before the thing ends and we see a final termination for the bulls in the long run.
Richard, thanks for joining us. Richard Morris joining us.